Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back, everyone, to another edition of All Things Financial. I wanted to go through the new tax law that everyone now it's really been thrown on all of us if we haven't paid attention in all the year 2018. Now when we're filing our taxes, we're going to be either walloped by a tax increase or rewarded with a bigger tax refund or a smaller tax due than we've had in years before. The big question is, which camp do you fall in? And what we're finding is the refunds look like they're slightly a little less than they were in previous years for a lot of taxpayers already. It's very early in the season, but the IRS reported they're down a little bit in the refunds that people are getting. They showed one example. The average refund last year was about $2,000, and the average refund this year looks like it's around $1,800. So it's about 10% less. But what accounts for most of that is, I think most of you will remember, your employers at the beginning of 2018 were instructed to reduce the amount they were withholding from your pay in anticipation of the lower tax rates. And that's what's accounting for you're probably, in many cases, paying a lower tax, but because some of it came in each paycheck, the refund might be lower. So the first thing I want everyone to do is get on these taxes earlier this year than in prior years. Get these to your accountant earlier and do some let them do some tax analysis for you. So if you do owe, you know better in advance. And if your refund's going to be a little bit smaller and you already had that year after year project in store for how much you were going to get back, to know in advance if it's going to be slightly less because your paychecks went up and some of that refund already came back to you. So that's the first thing we're seeing, and that's the first advice I have. Get on these taxes earlier this year than usual because it will definitely be different. We just don't know in which direction. So you don't want to get caught later on in this tax season, late March, early April, figuring this out because it's a little bit too late and the accountants will be too busy. So will all the tax helplines if you're using software or do it yourself. This law is fairly complicated, but here's what they said. The government came out, the IRS issued the new 1040, and it's a half a page, half of one sheet of paper, front and back. So that is tax simplification. And we would think this is simpler this year, then why do we have to get on it earlier? Well, because when you go and print the instruction, which should be an instruction page, the instruction pages are about 117 pages to print the instructions on how to fill out a postcard size simplified tax return. So that's why I say get on this early. Everybody's situations will change. And what I wanted to do before I start, I am offering everyone who's watching and listening a free report that I will send out to everyone from the IRS. It's a very nice pamphlet booklet explaining and highlighting the tax changes for each of you individually. And I have another one for those of you in business if you're interested in that one also. So if you contact me, I will get this out to you either PDF through email or send it regular mail for you in advance to begin looking into your own personal situation. Now let's dig into this. The Tax Cuts and Jobs Act is the name of this new tax reform. The big question everyone listening and watching is going to have is, are we going to be better off or worse off? We won't know until this first year's tax return is finished. So that's why I say do it early. But here are some of the changes that you want to be aware of. First, the tax brackets. When you look at tax brackets, The old tax brackets and the new tax brackets look similar, but they're different. What happened is there's 7 tax brackets still, but every income level fits into a different tax bracket, and it's to your betterment, actually. I'll explain that. And every tax bracket is a slightly lower tax rate, than the old tax bracket. So let me give you an example here. The first tax bracket is the same as the old tax bracket. It's the basic minimum, and it's a 10% tax level. So that's for the lowest income tax rate. People that earn under the threshold for the 10% basic income tax rate would pay no income tax. And I'll explain how that can work. But once you exceed and enter into the lowest tax rate, it's still 10%. But all the rest of them are lower. So the second tax rate up was 15%, as you'll all remember. It's now 12%. The third was 25%, and it's now down to 22%. And then when we shoot straight up to the top, the old rate, as you'll remember, was 39.6% maximum federal income tax rate. The maximum now is 37%. But the news gets better. The old tax brackets had an income maximum, whereas if you exceed this much income a year as a married filing jointly, then you're kicked into the next bracket. You're kicked out of the 15%, let's say. But the new brackets, the income is actually, you're allowed to earn more income and stay in the lower brackets. Let me show you what I mean. The 10% bracket, that's the basic minimum. It starts anywhere from 0, and the old, when you looked at that, versus the new limit is you can go up to $19,000 and still be in the minimum tax bracket. If you're married filing jointly, or if you're single, it's around $9,500, let's say. Well, when you push up and we go in all these different brackets, 15 and you now it's 12, it's going to help you a lot. Here's where we get. Let's say we have a married filing jointly couple. Their tax bracket can go up to $165,000 combined, and they're still in the 22% tax bracket right now. The tax bracket for the 12% can go up as high as $77,000 and still in the 12% bracket. That's next to the minimum. So they're lower than what they used to be. The tax bracket rates, as they change, you'll see this, I think, reflected in your tax returns, where you'll see a slightly lower tax rate than you were last year, even though your income's the same or maybe even slightly higher. The other thing you're going to want to know, you probably won't notice this, but every year they're indexing these tables, and they use that by a CPI factor. They're still going to do that. They just changed the CPI method. The government changed the CPI method, which will increase these tables. That's beyond the scope of today's discussion. I'm just mentioning that because next year will be slightly different numbers than this year. Now, here's the biggie in this tax reform. Everybody's heard of this already, I'm sure. Can we still deduct our itemized expenses? Can we still take charitable? Can we still take medical? Can we still take property taxes and mortgage interest? What's going on with the standard deduction, and what's going on with our personal exemptions? Can I still deduct 3 kids? Those are the huge questions, and those are the huge changes. Because the answer is no on most of that. Here's number 1. The standard deduction. Everybody is entitled to a standard deduction. And the old standard deduction versus the new standard deduction is a lot different. The old standard deduction for an individual, every individual was allowed to exempt up to the first $6,350 of their income if they were individuals. It's $12,000 now. So they've doubled the standard deduction in this new tax code. That means the first $12,000 of your income this year that would otherwise be taxable is exempt from tax through this standard deduction. The problem in the married couple, before I get into the problem with that, the married couples, last year, 2017's taxes, we had a standard deduction of $12,700. This year, the standard deduction skyrocketed to $24,000 for a married couple. Standard deduction. So every married couple, combined income, the first $24,000 of otherwise taxable income does not count, is not taxable. That's what a standard deduction is. That is the good news, and it'll stay good news for some of you, but it might turn into bad news for others of you. Because what we have lost is, with that standard deduction, we've lost the personal exemption. The old tax rule used to be, we'll take a standard deduction for mom, standard deduction for dad, standard deduction set was $12,000 or so, and then you get into the personal exemption for every kid under the age of 17. And we even had dependents that we'd get into, but you'd get a personal exemption of up to about $4,100 for each qualifying child. In addition, well, if you have 3 children, that's another over $12,000. So if the old standard deduction was $12,700 and you had 3 children, you were already over the $25,000. Well, that's changed now because the new standard deduction is $24,000, but there's no personal exemption deduction anymore for the kids. What we do have, though, is a child tax credit, which I'll get into, and that is helpful. The child tax credit has actually doubled. Last year it was $1,000 per child, qualifying child, which is under age 17. This year it's $2,000. A credit's huge because let's say we have a standard deduction $24,000. We don't get any kids deductions, but we get a credit. Well, that credit, we still have the same 3 children in this example. That tax credit is $2,000 for each of the 3 children. That's a $6,000 credit. That's way better than a tax deduction. Let me explain. A $4,000 tax deduction for a child means we get to exempt $4,000 of income from being taxable. But our tax rate might only be 15%. So to exempt $4,000 of income saves us $600 in tax. 15% of the income we don't have to count. Well, now the new law says it's a $2,000, not tax deduction, but tax credit. Tax credits are like checks to pay your tax bill. And let me make that clear. That means the government is giving you, in essence, for every qualifying child, a $2,000 check, in essence, to pay the bill that you owe on your tax. If you owe $4,000 on your income taxes this year and you have 1 child with a $2,000 credit, that credit applies directly to the tax and reduces the $4,000 tax to only $2,000 being owed. And if you have a second child with that same credit, you've just wiped out your taxes. That couldn't happen under the old tax benefit with a personal exemption because this tax credit is really, really big. So you won't know until you do your taxes, which works out better, but that tax credit's big. So don't fret too much if you get a $24,000 standard deduction and in addition, in essence, a $2,000 check to pay your tax bill for each child that you have qualifying under the age of 17, because that's huge. But I did want to get into that because the personal exemption's gone. And now we're back to, what about all those itemizations? That standard deduction of $24,000 works like this. In the old rules, we used to work up our taxes 2 different ways. We'd keep track of all our charitable contributions, property taxes, mortgage interest, medical expenses, and other itemized expenses. And we'd keep a list all year long, and we'd keep our receipts, we'd tally them up, and we'd give them to our accountant at the end of the tax year. And the accountant would work your taxes both ways every year, one with the standard deduction and one with the itemized deductions, and take whichever one's larger. So we all have done that. We're used to that. This year, they'll do the same thing. But because the standard deduction is now doubled, in essence, to $24,000 for a married couple, how are we going to have enough deductions in property taxes, mortgage interest, medical expenses, and charitable deductions to get over that number of $24,000? Well, most of us aren't. And it's estimated that 95% of all taxpayers this year will file the standard deduction now. Only 5% will find it beneficial or their itemized expenses to exceed that number. So most of us are going to truly have tax simplification. Most of us are truly no longer going to have to keep expenses and all those tallies on the mortgage interest and the property taxes. It's not that they're no longer deductible. They are still deductible. But we're no longer going to have enough of those expenses to exceed the standard deduction is being most likely predicted. And therefore, all of our expenses added together won't tally more than $24,000 most likely, so we'll just all take standard deduction. There comes our simplification. So our taxes are going to get simpler to file. You'll still have the personal exemption gone, but the child tax credit should help. Let me say one other thing about the child tax credit. After the child is older than 17, we do lose that child tax credit. But there is a up to $500 additional dependent care credit available in this new tax law for people either who are dependents, either maybe children older than 17. It can sometimes be grandparents that you're taking in. But check into this or check with your accountants to see if you have other dependents living with you that you meet the test of that they're a true dependent, that you might qualify for up to a $500 credit. And remember, a credit is a check. Well, it's the equivalence of what would be just like a check that offsets your tax bill directly. So it's not just a tax deduction. It's truly a credit against the tax bill. So it's big. A $500 tax credit might actually be equal to a $2,000 or $3,000 tax deduction. That's how big a credit really is. Okay, now, when we get into the new tax law, we do run into certain high income limits where we lose the credits. So if you earn too much money, and it's a lot of money, it's over like $240,000 a year, a joint married couple, you'll start losing these child tax credits. So be aware of that. It's not for everybody, but it's for most everybody. Now, remember in the years past, and I've done shows on this, we had education tax credits, college tax credits, student loan. We went into all of that. I'll touch on that here because we lost some and kept some on higher education tax credits. So here's what we have. We kept two of the most popular tax credits for higher education, and that's the American Opportunity Credit. That still remains. That's still in place. And the Lifetime Learning Credit still remains. That's still in place. So two of our most popular really tax credits and tax breaks. And remember, I'm using the word credits. So they're the good ones. They're better than tax deductions. Still exist. So there is good news there. But we run into some things that we don't get. So if you don't qualify for the American Opportunity Credit or the Lifetime Learning Credit, and you can always contact me and I can help do a worksheet and help you figure out whether you do or not. But if you don't, what we did lose are when we itemized tuition and fees, tax deductions for college expenses and all that. We lost that. And we used to be able to deduct maybe $4,000 if we didn't qualify for those other credits. We could still revert to, okay, well, maybe we get the tuition and fees tax deduction. So we'll itemize all our fees and tuitions and books and all that and see what we can total up to at least $4,000 and take them as a deduction. That's gone. So now we do have some problems if we don't qualify for those credits. Let's get into the 529 plans. 529 plans were actually favored and expanded use in this new tax law. A 529 plan, to refresh some of you who may not be accustomed to them, are tax savings plans, tax advantaged savings plans when we're trying to save money or put money aside in the expectation of paying for higher education or college expenses, that whatever we put aside, it's not tax deductible, but everything that grows inside that account, the earnings and interest and growth on it is not currently taxable. Year after year after year, the taxes are sheltered on that as being tax-deferred gains and interest. So we're not getting taxed all the way that account's building if it's in a 529 plan. And those can grow quite large, by the way. And many grandparents sometimes will help. In fact, all the family members, if you ask them to, will sometimes help at birthdays and Christmas, help you fund these 529 plans. Well, as they grow deferral, tax deferred, and it's sheltered from taxes all along the way. So they grow faster by not being robbed by taxes. And then at the end, if they are used for the purpose for which they were intended, when their college expenses come due, and they're used for the proper expenses that qualify on the 529 plan, all of that money, as it's liquidated down and depleted on those college expenses, comes out tax-free, free forever. So the 529 plan is a leverage tool to help make more of the money that some people are trying to save toward college. Well, thankfully, the 529 plans have not only been preserved, but they've actually been expanded, and it's welcome news for a lot of people. So here's what's happened. We had a choice prior to this: 529 plans or Coverdell. And those were the two plans that we could really use. The Coverdell Education Savings Accounts, we would abbreviate that as ESAs, Education Savings Accounts, but they were the old Coverdell Education Savings Accounts. But the 529 plans are the ones that are most popular. They are both preserved in the law, but the 529s did get expanded. And there's no deduction, again, as I said, for what we put into the 529 plan. But wow, do the benefits multiply afterwards. Again, you've got grandparents and family members helping you contribute to your child's college education. So that's great. But here's what was just added. It's not only higher education expenses now that those funds can be used for. It can be used for, and withdrawn tax-free, to be used for expenses which are qualifying educational expenses. So you have to meet that test, but at any level. So we're looking at private schools now, private high schools, let's say, for example, or private schools way before college, and they may qualify for a 529 funding, which means tax-free distribution. That's a big benefit now that didn't exist before. So look into that if you're in the Catholic schools or you're going into private schools. Look into this at any age now. These 529s are much more expanded use, not just for higher education, which is normally considered college. All right. Now let's get back into this mortgage deduction issue. The mortgage and the property taxes, what can we and can we not do? You can deduct mortgage interest. So don't let anybody tell you the deductions are gone. The problem is they're maximized, and you can't take more than so much on a mortgage. It's like a $750,000 cap on mortgages. No more than $100,000 on home equity loans or lines of credit or second residences, things like that. So there are limits. But the other one where you actually did lose this was if you took a home equity line of credit against your house, we could deduct that mortgage interest until now. Now we can deduct it only if the purpose for the money for the home equity was used to improve the home. So taking home equities to buy the cars now or fund college, we lost the income or the interest deduction on those. even though, like I said, the standard deduction's so high, we probably wouldn't have taken them anyway. What about charitable deductions? Are charities going to be hurting now? Well, I'll share two things with you. The charity deductions still exist, but one of the biggest changes, and they do still exist, but again, getting over that $24,000 is the hurdle. Most people will find that they're not able to get over that. I will share this with you. Anyone who's an IRA holder who's over the age of 70 and a half, there's a backdoor way to get money out of an IRA directly to a charity and satisfy your required minimum distribution. So this is a real strong way to move money to charities and not have to pay tax on the required minimum distribution. For those of you in IRAs or 401ks who are over age 70 and a half and subject to the required minimum distribution rules, there is a availability that you can make a direct donation to a charity directly from the IRA to the charitable institution and have it satisfy that year's RMD, which means you don't pay tax on the RMD. You got the donation over to the charity. So you couldn't deduct the charitable contribution anyway. But this way, you're not paying tax on the required minimum distribution either. So that's a win-win. Anyone who's got questions on that, feel free to contact me. I'll give you more details on that. But that is how some of us, older than age 70 and a half, can actually apply that rule and get a very, very beneficial effect to the charities. Now, medical expense. Yes, we can deduct medical expenses. It's subject to 7.5% of your adjusted gross income. So they dropped it from 10%, but it's going back to 10% next year. And most of us aren't going to be able to deduct medical anyway. For those who can, that means the medical expenses are very, very high. Some people are stacking medical expenses and charitable deductions. They're doing 2 years worth in 1 year, then nothing in the next year and filing standard deduction, and then doubling everything up again the following year. So you could think about that. It seems cumbersome to me, but some are able to do it. The other thing we used to be able to deduct, and there were a lot of complaints about this in New Jersey, New York, and California, are the SALT deductions, which are the state and local tax deductions. That's our property taxes, which are now capped at $10,000, by the way. But property taxes, state income taxes, sales taxes, and they're kind of capped. So it's a problem in the high income states, high tax states like New Jersey. Pennsylvania is not a high income tax state as far as the state tax. So it's not a big deal, but in the New Jersey, New York, and California and some other states is a big deal. All right, and then we have the alternative minimum tax and some other provisions there and the estate tax. But we're out of time today. What I'll do is I'll come back next week. We'll go into these taxes a little further, and I also have very, very beneficial news for most business owners. So make sure to tune in. Thanks again for listening to All Things Financial. I'll be back again next week.